Good afternoon. This is Ken Long from Tortoise Capital Management with the review of the weekly strategy report for August 27th, 2011. We have a market that remains in bearish, volatile conditions. On an annual basis, we're at 37 out of 100 on weekly RSI 14. Last week and the week before, we mentioned that when RSI gets below 30 and then comes back above, that has been often an opportunity to get in early on a rebound. So we're alert to that possibility. And we had another week of gains this week. On a 10-day basis, the short-term 10-day NDX, we're at 63 out of 100, so in neutral conditions. Percent stretch relative to the 200-day moving average is at minus 7.65%. That's bearish and coded red because it's among the worst readings of the last 6 months. The 5-day slope of the 50-day moving average is also coded red and bearish at minus 0.77. Both of these measures have improved this past week. ADX has come down to 40. Still a strong bearish trend. However, it did weaken this week with the buying pressure. ATR percentage came down a little bit, but still remains volatile at 3.39%. The 26 ETF portfolio remains with Swiss franc, gold, and treasuries. The 13 ETF with U.S. real estate, treasuries, and Japan. Next reevaluation on or about 1 September. The theoretical model for ETF2 is recommending 0% exposure, as all 10 of the regional ETFs are on a sell signal. Model portfolio itself is also at 0% exposed. This is a new report. This reflects the 13 and 26 ETF portfolios for the blended monthly rebalancing. On the 13, again, you can see the only thing that's favorable right now is treasuries, and in the 26 ETF, you can see we've got some commodities, short-term bonds, emerging market bonds, Swiss franc, and gold. Financials looking the worst so far of the 26 member ETFs. Looking now at the market health check. Again, the vertical blue lines are 10, 20, and 30-day look-back periods. The solid purple line at 137 is the previous swing high from late April. Dotted purple lines reflect resistance levels from previous excursions up. The solid black line in the middle is the regression, the 30-day regression line, still pointed downward. The slope, you can see, has bottomed out at about a minus 0.76, although it has improved slightly this past week on failure to fail further. So that's 2 weekly surges. Had the big down, one week up, 1 week down, 1 week up. That has slowed the decline of the slope line. And strengthens the case for support at about 112 at this solid red line. So we're just slightly above the midpoint of that regression line channel. The outer 2 black lines are the regression channel formed by the maximum excursion from that regression line, which you can see happened around 8 August. So failure to fail further for 3 weeks starts building the case for 112-ish being a support level. To violate this channel to the upside, we'd have to see a price about, looks like about 123. So price is right at the 10-day moving average, which is the solid green line. It's below the 50, and the 50 is below the 200. The 200-day moving average, you can see indicated by the shaded blue area, indicating we're still underwater. The ADX strength of trend has rolled over and come back to 40, but bears are still in charge. Bear volatile conditions. The red blocks represent 5% chunks of pullbacks from that 137 swing high. So we're right now into that minus 10 to minus 15, which would be considered bearish since it's slightly more than a that 10% correction. But we're close to threatening the upside here. We've got to get through, looks like about 121 to really make a serious run at 123. You can see the Williams percent R, we're closer to overbought than oversold, and haven't really tested that oversold condition since the 10th of August. The MACD histogram, or in this case the PPO percent price oscillator, the jaws are opening to the upside, so there is a hint that we have some bottoming action here at 112. So my interpretation of all this is that we have we've stabilized after the panic sell-off. We haven't proven the upside case, but the hints are there, and we've got some green shoots among the indices. I still think the dominant story is being told by the market and people's response to it rather than individual story stocks. So right now, as the market goes, I see the rest of the stocks following suit. ETF2, all 10 regions are negative on the moving average filter criteria. SPY is slightly better than EFA at 42 versus 35. Inside the U.S. indices, it's technology at 47, then large caps at 42, mid caps at 39, small caps at 36. The two strongest sectors are Japan at 43 and U.S. technology at 47. The two weakest are Latin America at 30 and European 350 at 32. So we're still remained at 0% invested, 100% cash in the theoretical model. Looking at the Tortoise World Market model here, we have the U.S. remains slightly below average once more, with large caps doing slightly better, as we've seen than mids and smalls. Japan, Asia less. Japan are above average. Strength in Asia can be found in Australia, Hong Kong, Malaysia, and Singapore. Malaysia's been a strong story, for a couple months now. European countries, not so much. Lots of red, and lagging the U.S. generally. Finance, both U.S. and global, has been horrible. The defensive sectors of staples, utilities, and healthcare remain strong in both the U.S. and global business sectors. All of the currencies look relatively good because they lose less on a percentage basis. Swiss franc still leading the way, although it has suffered and pulled back quite a bit. In the intermediate time frame, looking at the 100 by 200 crossover system, we have added a couple more shorts from last week, it looks like. Financials, Japan, Latin America, and semis. Gold and Treasury still the only buy signals. The top 30 in the ETF database, using that blended 3 and 6 month relative strength, dominated by the defensive plays: gold, precious metals, Swiss franc, bonds, silvers, currencies, all the bond funds, utilities, Aussie dollar, the bearish U.S. dollar index, agriculture and DBA, and blended commodities and DBC. So again, it's the defensive sectors once more. I really think that it reflects an opportunity on the upside for the indexes. That's where I think the surprise gains are to be made. We know what to do if they violate below 112, if SPY violates below 112, but if we got gains here, there's room on the upside for the indexes. So I'm cautiously optimistic and shortening my time horizon per usual. Looking at the top 30 ETF by daily dollar liquidity, we have all the same usual suspects in the top 10. No real change, still dominated by gold, silver, energy, and the VIX, which has gotten an extraordinary amount of liquidity lately.